Are you looking for some industrial dividend stocks to add to your portfolio? Well, today I got you covered. I'm going over 4 great companies that are all trading at good values right now, and with the potential for the market to be volatile this upcoming month, you'll be able to swoop in and benefit from the volatility and grab them at great prices. So let's jump in. Eddie V here, sharing stocks to help you on your investing journey. Jumping into our first stock, we have AOS Corporation, ticker symbol AOS. And they manufacture and market both residential and commercial gas, heat pump, and electric water heaters, boilers, tanks, and other water treatment products. Their main source of revenue comes from North America, and they also sell products in Europe as well as Asia, primarily China and India. Over here, the goal is to be the world's largest provider of water heating and water treatment solutions. And right down here, you can see their main focus is the water heater and water treatment. For the last month, they have fallen about 6.9%, giving them a current value of $57.21. That puts them very close to their 52-week low of $52.17, with a current market cap of $8.7 billion, and are trading at a PE of 16.01. Over on their income statement, looking at their revenue, you can see that year over year they have been steadily increasing their revenue, except for in 2020, which is understandable, and they have been able to rebound from that, which is a great sign. Going on here to their net income, we have once again they have been growing their net income year over year, except for 2020, and have been able to rebound after that, which is a good sign as well. Going down once again to their shares outstanding, we want to see that they are buying back shares, and looking right here, we're not disappointed. So they had 171 million shares, and currently they have 155 million shares. So definitely buying back shares. And also want to take a look at their dividend year over year. So they have been growing their dividend steadily, as you can see here, year over year, which is a good sign as well. Over in their cash flow, we're going to scroll down here to look at their free cash flow. And how you calculate free cash flow is from cash from operations, this line right here, and minus your capital expenditures, which is this line right here. And that'll give you your free cash flow. And why free cash flow is important is because it allows the company to do 5 different things, which is pay dividends, buy back shares, pay down debt, make acquisitions, and reinvest back in the company. So looking here, we can see that their free cash flow year over year has been increasing. One thing to notice is that while they had a drop in revenue and net income in 2020, they didn't have a drop in their free cash flow. However, we do see a drop this year. And right back up here, you can see there is an increase in their working capital costs. So something you might want to look into. We're going to take a look at their 5-year average, which is $409 million, and jump over to the balance sheet to see how long it'll take them to pay off their long-term liabilities. Over on their balance sheet, scrolling them right down here to their long-term liabilities, they have $600 million. So that'll give about 1.5 to 2 years for AOS to pay off all of their long-term liabilities if they chose to do so. Nice sign right there, they're not too far into debt. Taking a look at their dividend summary, they have a dividend yield of 2%, which will give them an annual payout of $1.12. Now the payout ratio right here looks like it's a miscalculation, so I'll skip all that for now. And for the last 5 years, they have grown their dividend at a rate of 15.71% with a dividend growth of 10 years. Seeking Alpha gives AOS a dividend safety score of B and a dividend growth score of A. And Dividend Tracker gives them a dividend safety score of 94. I'm jumping over to a new tool I'm exploring, and this is from Jimmy, and his YouTube channel is Learn to Invest. So this is basically a discounted cash flow calculator. And looking at AOS Corporation, you see based on current price, it is trading at fair value. And they also have listed here, if you're not including debt and cash, it gives you a calculation here as well. And this is grabbing analysts' assumptions and doing a calculation based on that. Speaking of analysts' assumptions, I have a list right here for the earnings per share. You can see analysts are seeing that there is going to be a drop in the next couple years, and then it should start rebounding from there. And scroll down here for their revenue estimates, the same thing. So the potential seeing a drop, and then it'll start rebounding from there. So as a long-term investor, you're looking in the long term, not just from year to year. So that's a good sign to see that they're estimating it'll rebound from there. Moving on to the next stock, we have MSC Industrial Direct, ticker symbol MSM. And they are one of the largest industrial distributors focusing on metalworking and maintenance. And they also have repair and different operational products. And they have over 1.9 million products and they distribute it throughout North America. Speaking of their 1.9 million products, you can see right here just their product catalog, and they have different clamps, the fastens, hand tools, HVACs, different faucets, and they have machinery, power tools, and different safety tools, and so on and so on. So pretty much a lot of stuff you'll see in Home Depot and Lowe's. Over in Seeking Alpha, looking here, from the start of the year, they have fallen about 4.7%, and from this last month have fallen about 3%, giving them a current share price of $79.97, which leaves them about their midpoint of their 52-week range, with a high of $87.99. Right down here, they have a current market cap of $4.4 billion and trading at a PE of 12.83. Over on their income statement, looking at their revenue, you can see here that prior to 2020, they were increasing steadily. And then the last 2 years kind of been stagnant while they're catching their feet back up. And this year they have started to rebound. So they're at $3.5 billion, with the previous year being at $3.1 billion. Scrolling in here to the net income, once again, just like the revenue, you can see here that they were increasing prior to 2020, and then they've had to drop there since then and have rebounded this year. So that's good to see. Scrolling down once again to shares outstanding, and they were buying back shares. Seems in 2020 they did increase it, and this year they are starting to buy back shares again. You can see here they went from 55.56 to 55.94, and now they're buying back 55.91 million shares. Also, want to keep in mind that with their dividend, they were increasing year over year. However, since 2020, they have stagnated it. One good thing to keep in mind is that they have been able to manage that 3%, so they haven't cut their dividend, and they're being able to consistently pay that since 2020. Over in their cash flow, we want to take a look at their free cash flow. Their free cash flow has kind of been up and down throughout the years, and the last couple of years since 2020 it has fallen. Right in here you can see they had a nice spike up in 2016, and since then it has been increasing, and since around 2020 it has fallen. You can see right here we have been in a downspin, so most likely they're starting to pick themselves back up from 2020, but that gives them 5-year average of $252 million. Jumping over to their balance sheet, let's see how long it'll take them to pay off their long-term liabilities. And right down here, looking at their long-term liabilities, with a current value of $691 million, it'll take them about 3 years to pay off all of their long-term liabilities. Over on the dividend summary for MSC, they have a dividend yield of 3.82%, which gives you an annual payout of $3. The payout ratio is 53.5%, and they've been growing that dividend for the last 5 years at a rate of 10.76%. And right now, since 2020, they have a dividend growth of 0. However, looking here prior to 2020, they have consistently paid their dividend for the last 18 years. So there's a little more data to look at that. And Seeking Alpha is giving them a dividend safety score of B and a dividend growth score of A, and Dividend Tracker gives them a dividend safety score of 56. If I get the fair value calculator for MSC, right now we are above what they're calculating as the fair value, so a fair value of $70, and if you don't incorporate debt, it'll be a fair value of $85. So it's pretty much right in the middle, and I'm considering it as a good value at this time right now, and most likely with the volatility has the potential to continue to drop, and you'll be able to pick it up at a great price. Also want to take a look at what analysts are predicting for the earnings per share. So you can see right here, they are seeing a drop in the next few years, and it'll start picking up from there, just like we saw with A.O. Smith. And right down here for the revenue assumptions, pretty much the same thing, kind of drop in the next few years and it'll pick up from there. So goal is for the long run, so that's a good sign for us that it should be steadily increasing as time goes on. If you've been finding value out of this content so far, let me know by smashing the like button, and also comment down below what industrial dividend stocks you already have in your portfolio. Moving on to the third stock, we have Caterpillar, ticker symbol CAT. As you're most likely familiar, Caterpillar manufactures and sells construction and mining equipment, diesel, natural gas engine, and also industrial gas turbines worldwide. I don't think I've ever seen a construction site without a Caterpillar vehicle there. And just to give you a view of some other brands besides their flagship Caterpillar, I'll just scroll in here. You can see like Anchor, of course, Caterpillar, and they have NWM, M2M, and Turner. For the start of the year, Caterpillar has fallen 12.5%, and within this last month, about 3.5%, giving them a current share price of $180.86. So they are trading close to their 52-week low, which was $167.08. Right down here, we have a market cap of $95 billion, and they are trading at a PE of 14.41. Over on the income statement, look at the revenue right here. You can see that they, after 2015, we're dropping a little bit, and then we're rebounding, and then of course 2020 happened. So right now, with their current revenue, they are coming back to what they previously had at 2020. So it's a good sign to see their rebound in there. Going down here to their net income, just like their revenue, their current net income is starting to get back in line with what they had prior to 2020, which was $6.28 billion. Going down once again to their shares outstanding, and you can see here, kind of like what MSC had, they were issuing shares after 2020, and right now they're starting to buy back shares. So they had a nice drop right here from 547 million to 531 million. And as far as their dividends per share, they have been slowly increasing that year over year, which is nice to see. After 2020, it looks like they pretty much kept it the same, and this year they bumped it up again. Over on the cash flow, just scrolling down here to their free cash flow, you can see here it's been pretty up and down the last couple of years. Had a nice spike up before 2020, and right now it looks like they started to get back. You see it drop down here, and just looking up here, once again, it looks like there's more costs in working capital than there has been the previous years. So most likely due to that drop right there. Overall, their 5-year average is $3.73 billion. So jumping over to their balance sheet, scrolling down here, going to its long-term liabilities, they have a current value of $36 billion. So it'll take them about 10 years to pay off all their long-term liabilities. Over on the dividend summary for Caterpillar, they have a dividend yield of 2.66%, which will give you an annual payout of $4.80. Their payout ratio is 39.7%, and their growth rate for the last 5 years has been 7.95%, and they've been growing that dividend steadily for the last 28 years, making them a dividend aristocrat. And Seeking Alpha gives them a dividend safety score of A- and a dividend growth score of B+. And Dividend Tracker gives them a dividend safety score of 75. And over here at the fair value calculator, you can see that the current share price is above what it calculates as a fair value of $173, and it is getting close to that. We're at a $180 right here. And of course, if you don't look at their debt, because they do have a large amount of debt, the fair value is around $231. Once again, just looking at analysts' assumptions, you see a slight drop there, and it should be staying pretty steadily, which is a good sign. And as far as revenue, right here, pretty much the same thing. We'll have a slight drop and bring back. So it seems like it's a current trend with all the companies we've looked at so far. Moving on to the next company, we have Stanley Black & Decker, ticker symbol SWK. Stanley Black & Decker is pretty much known worldwide as the manufacturer of hand and power tools, and they sell throughout North America, Europe, and also Asia. They have 3 different segments, which is most noticeably is the tool and sales, and this what generates most of their revenue, and this provides different hand tools and professional products to different retail stores like Home Depot and Lowe's. They also have security systems and services that they provide, like different alarms monitoring and video surveillance. And lastly, they have industrial, which provides engineering, fastening systems and different products to customers, whether it's automated manufacturing, electronics, construction. Just in case you're not familiar with what brands that they sell, they have, of course, DeWalt, Black & Decker, Stanley, as well as different outdoor mowers and tractors. From the start of the year, Stanley Black & Decker has been extremely hit hard with a fall of about 53%. And over this last month, they have fallen about 11%, giving them a current share price of $87.48, which will bring them pretty much at their 52-week low of $84.63. They have a current market cap of $12.7 billion and trading at a PE of 15.43. Over on their income statement, looking at the revenue, you can see here that they historically has been growing year over year. This last year, they've had a slight drop, most likely has some effect to why their stock price has dramatically dropped throughout the year. Scroll down here, we have their net income. And looking right here, it has been up and down, especially the last 2 years after 2020. And currently right now, it seems like they are back on their feet from current profits prior to 2020. So they're back in the billions. Scrolling right down here to their shares outstanding. Just like the other 3 companies we have looked at today, after 2020, they have issued some shares and right now are buying back shares. They bought back a lot of them within this last year. And their dividend has consistently been growing year over year. So that hasn't stopped, which is good to see. Over in their cash flow, just scrolling right down here to their free cash flow. And the first thing that sticks out is that they are in negative right now. Right here, you can see just like the other companies, their working capital has had an increase of costs this past year. And prior to that, they were bouncing around that 1 billion. So their current 5-year average is $454 million. And they do have a lot of debt, so let's go take a look at that. Scrolling down here to their long-term liabilities, you can see that they have $8.52 billion in debt. So it'll take them about, let's just say, about 20 years to pay off all of their long-term liabilities. So that is one thing to consider when you're looking at Stanley Black & Decker, that they do have a lot of debt. Over on the dividend summary, they have a dividend yield of 3.75%, which will give you an annual payout of $3.20, and their payout ratio is 36%, and they've been growing that dividend at a rate of 6% for the last 5 years, and have steadily grown that dividend for the last 53 years, making them a dividend king. So they do have history behind them. And Seeking Alpha gives them a dividend safety score of A- with a dividend growth score of C, and Dividend Tracker gives them a dividend safety score of 65. Over here on the fair value calculator, we do have a fair value of $54. You can see here, that's primarily due to all the debt the company has. Without the debt, it's $128. Since we are investing for the long term, I'm going out about 10 years. You can see it has increased to about $71. For me personally, I do see it a good value right now. It's kind of in between before debt value is, and then after debt value, it's kind of right in the middle there. So I do think it's at a good value, and potentially the price will continue to fall, as we've seen pretty much throughout this whole year. Lastly, looking at the analyst's projection for the earnings per share, you can see here that this year it's in the negative, so we're going to continue to fall, and it'll have a little bit of fall and pretty much stay around that 20%, which is what they're seeing. And right down here for the revenue, you can see the next couple of years will be in the negative, and then it'll kind of rebound there, slowly kind of pick up. It looks like it rebounds and drops again. Keep in mind that we're in for the long-term investments and not for year to year. I think that all four of these companies are trading at a fair value right now, and potentially at the end of the month, they'll be trading at even a greater value. If you're looking for more stocks to add to your portfolio, check out my top 4 REITs, and for other stock analysis, check these bad boys out. Catch you next video. Peace.